Your 20s and 30s are the most powerful years to invest, not because you need a lot of money, but because you have time on your side. In this video, we're breaking down proven investing strategies for young adults, whether you're just starting out or looking to level up. From index funds to Roth IRAs to avoiding rookie mistakes, these are the moves that lead to long-term success. Before we get into the money moves that matter, make sure to like, subscribe, and tap that notification bell so you don't miss any financial tips designed to set you up for life. Let's start building wealth early and smart. Start with Emergency Fund Foundation. Before diving into investments, secure your financial foundation with an emergency fund. This isn't just conservative advice, it's strategic protection for your investment journey. Aim for 3 to 6 months of living expenses in a high-yield savings account. This fund prevents you from touching your investments during unexpected situations like job loss or medical emergencies. Without this safety net, you might be forced to sell investments at the worst possible time, potentially locking in losses. Your emergency fund acts as a financial buffer, allowing your investments to grow undisturbed. Start with $1,000 if you're just beginning, then gradually build it to full coverage. This foundation gives you the confidence to invest more aggressively because you know you're protected. Maximize tax-advantaged accounts. Tax-advantaged accounts are your secret weapons for wealth building. These accounts offer either tax-free growth or immediate tax deductions, dramatically accelerating your wealth accumulation. The 401 should be your first priority, especially if your employer offers matching contributions. This match is literally free money, a guaranteed 100% return on your investment. Contribute at least enough to get the full employer match. Then consider increasing contributions annually. Individual retirement accounts, both traditional and Roth, provide additional tax benefits. Roth IRAs are particularly powerful for young investors because you pay taxes now at potentially lower rates and enjoy tax-free growth for decades. Max out these accounts before investing in taxable accounts. The tax savings compound over time into substantial wealth. Embrace index fund investing. Index funds are the closest thing to a guaranteed wealth-building strategy. These funds track entire market segments, providing instant diversification and consistently beating most actively managed funds. The S&P 500 has historically returned about 10% annually over long periods, making it an excellent foundation for young investors. Low fees are crucial. Even a 1% difference in fees can cost you hundreds of thousands over a career. Look for funds with expense ratios below 0.1%. Total stock market index funds give you ownership in virtually every publicly traded company, while international index funds provide global diversification. Don't try to time the market or pick individual stocks initially. Index funds remove emotion from investing and provide steady, reliable growth that builds substantial wealth over time. Implement dollar-cost averaging. Dollar-cost averaging is your defense against market volatility and your own emotions. Instead of trying to time the market, invest a fixed amount regularly regardless of market conditions. This strategy automatically buys more shares when prices are low and fewer when prices are high, reducing your average cost per share over time. Set up automatic investments to remove the temptation to skip months or try to time the market. Whether it's $200 monthly or $2,000, consistency matters more than the amount. Market downturns become opportunities rather than disasters because you're buying quality investments at discount prices. This approach has worked through every market cycle and removes the stress of trying to predict short-term market movements. Diversify across asset classes. Diversification isn't just about owning different stocks. It's about spreading risk across various asset classes that react differently to economic conditions. Your portfolio should include domestic stocks, international stocks, bonds, and potentially real estate investment trusts. This mix provides stability during market turbulence while maintaining growth potential. Young investors can typically handle more stock allocation due to their long time horizon, but some bond exposure provides ballast during volatile periods. International diversification protects against domestic economic downturns and provides exposure to global growth opportunities. Real estate investment trusts offer inflation protection and income generation. Rebalance annually to maintain your target allocation, which forces you to sell high and buy low. Consider real estate investment. Real estate can build wealth through rental income, tax benefits, and property appreciation, but it requires capital and management. REITs offer a hands-off option with dividends and liquidity. Or try house hacking. Live in one unit, rent out the rest to offset your mortgage. Understand risk tolerance and time horizon. Your biggest investing advantage is time. With decades until retirement, you can ride out market ups and downs and benefit from long-term compound growth. This allows for more aggressive strategies that aren't suitable for older investors. But knowing your risk tolerance is key. If downturns make you panic, start with a balanced approach and adjust as you grow more confident. The biggest risk isn't market volatility. It's not investing at all due to fear or delay. Avoid common investment mistakes. Young investors often make costly mistakes that can derail their financial future. Trying to time the market consistently fails and often results in buying high and selling low. Emotional investing based on fear or greed leads to poor decisions and reduced returns. Chasing hot stock tips or trendy investments usually ends in disappointment. High fees and frequent trading erode returns over time. Putting all money in savings accounts seems safe but actually loses purchasing power to inflation. Not starting early enough costs millions in compound growth. Cashing out retirement accounts for current expenses destroys long-term wealth building. Focus on consistent, low-cost, diversified investing rather than trying to beat the market through clever strategies. Monitor and adjust strategy. Successful investing requires regular monitoring and periodic adjustments. Review your portfolio quarterly to ensure it aligns with your goals and risk tolerance. Annual rebalancing maintains your target asset allocation and forces disciplined buying and selling. As your income grows, increased contribution amounts to accelerate wealth building. Life changes may require strategy adjustments. Marriage, children, or career changes might affect your risk tolerance or investment timeline. Stay informed about market conditions and economic trends, but don't let short-term news drive investment decisions. The key is staying committed to your long-term strategy while making thoughtful adjustments when circumstances truly warrant changes. And that's how you invest in your 20s and 30s, with strategy, consistency, and a long-term mindset. The earlier you start, the bigger the payoff down the road. If this gave you a clearer path forward, smash that like button. Drop your investing questions or wins in the comments, and subscribe for more smart money advice tailored to your journey. Don't forget to hit that notification bell, because your future wealth starts with what you do today. Until next time, invest early, stay consistent, and let time do the heavy lifting.